Hey, everybody, and welcome to Divorce and Home Financing. I'm Cindy Bishop with Cindy Bishop Worldwide and would like to introduce you to Jolene Moore today. Now, for those of you that don't already know Jolene, I want to make sure you know that she's Vice President and Senior Home Loan Consultant with MainStreet Home Loans. Her office location is in Fairfax, but of course she goes anywhere. She's also a very good lender, very good business development trainer, very good lender trainer. I think she was born to train, and she's also a top producing, top tier lender. So, and definitely she gets a lot of referral business. So consider her when you are thinking about who you're going to have as a team member for your home loans. And welcome, Jolene. Take it away.
Thank you, Cindy. Thank you all for coming here on a Friday morning. I think Cindy and I talked about, I've never taught on a Friday morning with her. So this was something we were trying out. So I appreciate all of you that hopped on. So I also haven't taught this class with Cindy before. I have taught it in other settings, and I'll tell you guys a little bit about that. But I thought it would be good information for you all to have. Unfortunately, we do know a lot of clients, that go through divorce and the impact that it can have on their, ability to purchase a new home, to handle their marital home that they have, if they do have one. And also I'm going to talk a little bit about credit also, as well as for you all when you're looking at potentially listing a home in this situation as well. So we'll kind of touch on all of those. The way I wanted to start today was I wanted to ask you all a question first. And I would love for you to just give me anything that you were hoping when you came to this class today, because we had a lot of people show up, and we actually had 20 people sign up. We had, I think, 40 sign up and 20 of you show up, which is amazing. So I'd love to hear what you are hoping to learn by coming today. So if you could just put it in the chat box, I have that up. If you want to unmute yourself and tell me, I would love to hear from you so that I make sure that I touch on what you all were hoping to learn by coming today. So if you could, like Cindy said, I love participation. So I really appreciate if you can participate with me and give me some information. That would be super helpful. And also once I do start, if you guys have any questions at any time, please ask, like I said, in the chat box, unmute yourself. Any of those methods will work, and I would love to hear from you. So I haven't heard from anybody yet. Someone put it in the chat box of what you were hoping to learn by coming today. Or if there's something, question that you already have. All right, so Claire, how to advise clients who are going through divorce or who have recently been divorced, just want to be educated and informed. Thank you, Claire, for being the first. I appreciate it. All right. And Amy, the top 5 considerations should be addressed with a person who is considering divorce or recently divorced. Don't really know about this. Very curious. Awesome. Love that too. And want to know what the unusual different practices are in financing for divorce versus non-divorcing. All right. Perfect. Thank you all. And what are documents required from a listing from a divorced couple? Okay. All right. Thank you, all of you who put those in. I appreciate it. And we'll make sure that we cover that. And then how to help clients that have experienced a divorce. Okay. So, when I speak of this, I'll share my personal experience. I've gone through divorce myself. So I know this from firsthand experience, as well as I work with a lot of clients that have gone or are going through a divorce when we're looking at purchasing a home. I tend to work with a lot of the women. I think probably because I am a woman. A lot of the agents I work with know that I've gone through the divorce and know that I have the understanding, but also the empathy, because obviously when you go through a divorce, as we all know, it's a very difficult time in everyone's life. So we want to work with someone that's going to help us, feel comfortable and not overwhelmed, and who kind of has an understanding of what they're going through. So you can, just kind of know that about me. The other thing I'll tell you guys about is that because I did this, have gone through this, one of the things I did for several years, and when COVID happened, this kind of stopped. But one of the things I used to do was I volunteered at an organization. It was called Second Saturday Workshop. It still is around. They're doing it virtually. Unfortunately, I haven't been able to participate, and it's something I want to get back into. But it's a great workshop. That's free. It's free, but some of them might charge like $25 or something like that. It's geared for women. And again, it's basically the professionals that are there are divorce attorneys, a lender, a counselor, a financial advisor, and a realtor. So they have these 5 different professionals who come in and give a presentation on their, like, kind of how divorce relates to financial advising, to the attorney. Obviously, that's a big, impact and a big part of the presentation, because there's a lot of questions regarding that. Also, obviously we also know there's, the mental health associated with going through a divorce. So there's a counselor there that talks about things, that they want to keep in mind when going through a divorce, the lender, and then also the realtor. I didn't put realtor because obviously you guys are all realtors. So, but that's, those are the people that are involved. So why I say this too is I also want you to think about when you have clients, and I know this is geared towards women, but in general, men as well, all of us need to have resources when we're going through this step. So if you have a client that reaches out to you, I think it would be great for each of you to have someone that you could potentially recommend to them in these different categories. And this is a great way for you guys to create relationships with these individuals, because obviously those can be referral sources for you, but it also can be a referral source for you to give back to them and help your clients. So this is something I would say that if you're, thinking about, and if you've been working with a lot of divorce clients, and, unfortunately, we know a lot of our population goes through this, these are people that you want to think about, who do I have in each of these areas that I could be recommending to a client when they come to me, so that we're helping them, in the well-roundedness of their life, and not just focusing on the real estate portion of what's happening with them with the divorce, but, all of that picture. So, Second Saturday, if you Google it, Second Saturday Workshop, it'll come up and it'll show you all the different locations of where it's offered in our area. So I highly recommend that. All right, so let me look. And someone else said, particularly concerning how a wife who's not a primary income earner can afford to buy a home. And then I am to have a listing appointment today, and the husband gave the house to the wife through the, okay. All right, so we'll talk about that. All right. So the first conversation, when I have a client that reaches out to me and says that they're either going through a divorce or newly divorced and they want to look at purchasing a home, or if they are going through the divorce and there is a marital home involved and they want to potentially look at, keeping the home, or their other spouse is going to be keeping the home and they're going to be moving out, what does that look like? So one of the things that I'm going to ask them first is there a property settlement agreement? So I want to know, is there agreement in place that shows if there's any income coming to the spouse that I'm talking to, or if there's, liabilities that they're going to be having to pay out to the other spouse? And if so, for how long are they going to be responsible for either paying a liability or getting one back? What is happening to the marital home? Is there, because a lot of times in the separation agreement, the divorce decree, it spells out who is keeping the marital home, or if there is money owed, to the other spouse when keeping the marital home. And so then we also need, and if it's, so we're going to look at that. We're going to see if there's a property settlement agreement and find out more details related to that. We also, if they've gone to this where they are actually now divorced, we also want to get a copy of the divorce decree. Those are normally two different documents. In Virginia, as we probably all know, there's no official separation. You're basically married up until the day you're finalized for divorce. So like, for instance, when someone fills out an application with us, technically they are married and legally married up until the day that the divorce is finalized, because Virginia does not have a legal separation period. So if they're actually gone through and where the divorce is now considered legally, complete, then we're going to get the divorce decree as well. And the reason why is because the divorce decree gives us a little, shows that it's now court ordered, because the separation agreement usually is not. It's usually an agreement, that's put together by the two parties. It could be done with an attorney, but it's not actually gone to the courts, where the courts actually, stamped on it and said, all of this in here is now court ordered. That usually doesn't happen until the divorce decree. So that's why we're going to get the divorce decree as well. So again, this is information for you to know, like what we might be asking for from the client, but also I think it's things that are important for you to know when you're having those initial conversations. The other thing that's important for us regarding that separation agreement and the divorce decree is if there is a debt besides the marital home, and so let's say it's a car payment or credit cards or things like that that has been listed in the divorce decree that says that is now the other party's responsibility. We now do not have to count that debt against them for qualifying for a new mortgage, but that only it happens if it's been or court ordered. So that's why, having the divorce finalized can help a little bit more in regards to what debts we might have to count if those debts have been assigned to the other spouse. Anyone have any questions regarding this part of it initially? All right, we'll go on. Child support and alimony. This is also a question that I get frequently is, can we use child support and alimony for qualifying? And that's one of the things, I think on the questions that you guys just asked me is, if it's particularly like, that question was, if it's a woman that's been staying at home with the children and not being the primary wage earner, how can she qualify for a mortgage? So one of the ways that they would be able to do is if whoever is receiving the child support or the alimony, we have to show that they have been receiving it for at least 6 months. It used to be 3 months. A few years ago, they changed and unfortunately increased it to 6 months. So that means we have to show that spouse has been receiving the child support or alimony from the other spouse for at least 6 months. And we have to be able to document it. So that would be bank statements or canceled checks, something that is showing us that this payment that's listed in that separation agreement has been regularly coming to the spouse from the other spouse for that 6-month period. They do have to be consistent. So unfortunately, I've had where, a spouse might have missed a month in the past 6 months. That can cause an issue for us and our abilities to be able to use that income coming in, because we have to show that it's consistent and that it's been received 6 months. We also have to show that there's a continuation of 3 years. So, most of the time in an alimony situation, they're going to outline in that divorce decree, here's the alimony payment, and they're going to be receiving it until this date. So that date has to be at least 3 years from the day that we're going to be closing on the new mortgage. For child support, it has to, again, also be continuing for at least 3 years. So one of the questions I usually ask when I'm talking to a client is if they're getting, child support is how old are the children? And we have to show that the children are of age to where they're going to be receiving that, again, for at least 3 years from the date of closing. Now, one of the caveats to that is, let's say they are a freshman, but they're an older freshman, right? So they're 16. So technically they would only be receiving it 2 years, but we also can, most of the time it says 18 or graduating high school or out of school or something like that. If that's the case, then we would have the ability to use that because, they still have, their sophomore, junior, and senior year that they're going to be receiving that child support. So there's some, things that we'll look at to make sure, like we've gotten transcripts from the high school to show what age, what grade they're in, so that we can justify that we have that 3-year period left, even though their age would make it look like we don't. So those are some things that we work through as well to try and help them. Now, the thing too, to keep in mind is, let's say they have 3 children. So they're getting, $1,400 for the 3 children. And now one child is going to age out and they're going to stop getting that for one of the children. Normally what we do is we take that amount, divide it by the amount of children, and then still use like 2/3 in that situation for the child support and not be able to use the full amount. So there's ways that we look at that too, to still be able to continue using part of the child support if one of the children is going to be aging out of that support. We also need to have something in writing from both parties that are signed by both parties detailing, the amount. So there's been many situations that I've had, because fortunately I've had a lot of amicable divorces that are not necessarily always using an attorney, or, they've started kind of doing they created an agreement on their own. They didn't really have something in writing, but the other spouse has been paying the other one and they've been receiving it consistently. So it doesn't always have to be court order. It doesn't always have to be an official legal agreement as well, like a separation agreement. We've had letters written by both parties, stating that there's no financial obligation, or here's what the financial obligation looks like. And, I'm paying this, my spouse, this amount for child support, and it's going to be continuing until this, and then both parties sign it. Sometimes usually we have to have it notarized so that we're, verifying that it is actual both parties that are signing it, and not, a little bit of faltering going on there. So those are some things to keep in mind regarding alimony and child support. And the other thing is if it's the other spouse, the spouse that is paying the money is now wanting to buy a home, we also have to count the debt, if any alimony or child support that the spouse who's paying that is paying out. And the thing with that one, which is a little different and not probably as fair, but we have to use that no matter, like, there's no 3-year continuance like there is to use it for income. If that child support payment or alimony is still being paid on the day that we go to closing, we have to use that amount as a liability in their debt to income ratios. Let me ask you guys a question. Do you guys see that I have your like all the, oh my gosh, I can't think of what I'm trying to say. The pictures of everybody up. Do you guys see that on the screen? I'm not blocking you from being able, or do you see it? You do see it? Okay, then let me move it. I didn't know for sure if you saw that or not. Okay, I'll move it out of the way. Okay, so yeah, so anyone have any questions on the income and any situations that you guys have encountered with clients?
Please try again.
All right.
Hello, yes, I have a question.
Sure.
Okay, so how would we know if there was payment and that person already got remarried? Do we have to ask any client, have you had divorce before? Or sometimes they
I think
have
it's
these
helpful.
payments, but I'm sorry?
Yeah, no, I think it is helpful to ask if there's any obligations that they have. I mean, for you, it's probably not as imperative because it's not impacting, their potentially the transaction of whether or not they're listing, or, I mean, if you see, like, obviously when you guys go to listing appointment, you're going to look to see who are the owners on record. So if that's something that I would definitely recommend if you're not already doing, but I'm sure you are. But then you can see if there's still potentially another person besides the person that you're meeting with to see if that's an ex-spouse that just hasn't been taken off the title, because we do see that. But I think it's helpful, like if you're, depends, some agents go further into finances than others. If you're an agent that's talking about helping them, trying to figure out what they could potentially, might be available to them, or, anything like that. Like I had an agent that was looking at their debt to income ratios. I wouldn't suggest it because that's why you have us and that expert. But if so, we would ask, like I would ask them, and it comes up. That's the thing, is not everyone wants to share it, but there's ways that we're going to see it. So if we see it, we're going to then have to delve into it. So the more, I would say that you could say something like, the more, be as open as you can with your lender, because the more information you give them, the better they're able to help you. And that there's not anything down the road that could cause issues. So like if someone, is remarried, but still has to pay alimony to an ex-spouse, we're going to see it coming out of their bank statements. So they need to be upfront with us from the beginning so that we make sure when we're pre-approving them that we're doing, helping them to our best of our abilities.
Okay, great. Thank you.
Sure. Thank you. Anyone have any other questions? All right. Okay, something else to keep in mind, this is just a little tidbit to throw out there, is child support isn't taxable when you receive it, alimony is. Child support isn't tax deductible if you pay it, but alimony is. So those are some things to keep in mind. All right, marital home. And this is something, for you all, and some things to think about. And then also, questions that your clients might have. So one of the things that Fannie Mae and Freddie Mac allow when someone is going through a divorce, like in this situation, and they want to buy out a spouse. So if one spouse, if they have a marital home and one spouse wants to buy out the other spouse, then if it's spelled out in the separation agreement, the settlement agreement, it can be considered a rate and term refinance. And so why is that important? The rate and term refinance allows us for, it's the best interest rate. So when you look at refinancing, which I'm sure many of you have over the years, one of the things we're going to look at is this considered a rate and term refinance or a cash out. Normally, when you're taking equity out of the home, and you're going to walk away with money after closing, that's going to be considered a cash or refinance. The rate is higher and the loan to value guidelines are more restrictive. And normally we can't go over 80% loan to value when we're doing a cash out refinance. When it's this situation, when it's done because you're buying out a spouse due to a divorce, we can do it as a rate and term refinance. So it's the best rate you're going to get when looking at refinancing. And it also allows us to go higher on the debt to income ratio. So we can go up to 95% on the debt to income ratios. And, obviously there's mortgage insurance involved and things like that, but they can walk away with the funds and money that they need to be able to pay off the spouse. Again, we have to have this spelled out. Normally, we want to see that it's spelled out in with a specific either percentage or amount. So let's say, this spouse is owed $50,000 from the other spouse, then we can, do the loan to allow the other spouse to receive $50,000. Normally what we do when we do that too, is we put it on the settlement statement. Like, how when you do a settlement statement on a refinance, you're going to show the payoffs. So the lien that you have to pay, the current mortgage, then it's also going to show here's a payoff to the other spouse. So it's outlined on the settlement agreement. So it lets Fannie and Freddie know that this was the purpose of why we were doing this and why we didn't do it as a cash out refinance. The other thing that I always talk to clients about in this situation when they're looking at buying out a spouse is they need to take into consideration the cost if they were selling the home. Because obviously if they were selling it, they're going to pay, real estate commission. And then they're also going to have, other closing costs involved in the transaction. So they need to take that into consideration as well when they're looking at calculating how much that spouse is due, from the equity that's, in the home, because those costs would be incurred if they were selling it, which would be the only other way that spouse is going to be getting the money. The other thing is and I'm going to get into this a little bit later. The other thing about recommending to them for you all to do a competitive market analysis, a CMA, rather than doing an appraisal, is a great way for them to calculate what that potential value of the home is, to when they look at splitting that equity that's due. So I'll get into that in a little bit. And the other thing to keep in mind, so there's situations where, couples keep their finances separate, right? So one spouse might be paying the mortgage out of their own account, or like I've said before, they've actually separated. They never did anything legally, but one has moved out and the other one's now been making the payment. If that's the situation, and let's say the spouse that's been living there has been making the payments, but can't really either for one reason or another qualify to get a mortgage to be able to get the other one off the loan, and this other spouse is willing to stay on that loan, but wants to look at buying their own home, if we can verify that the spouse that's still, that one of the spouses has been making that payment for at least 12 months out of their own account, then we wouldn't have to count the mortgage payment against the other spouse when they are going to look at purchasing a home. And that, again, documentation wise is going to be done by, because most people are paying online now, it would be bank statements. So we would need to have 12 months bank statements showing that spouse has been making the payment out of their own account, so that we then don't have to count the payment against the other spouse. The other thing I would always recommend too is, a lot of people don't understand capital gains. So, when we were talking about having those resources, I would say having a CPA as a resource in this situation is also super valuable, because of course everyone's concern is there going to be capital gains? Most of the time in most situations, married couples have an exemption on capital gains up to $500,000. But again, that's a conversation you want to have with the CPA. So having someone that you're going to be able to recommend to your clients is very important in this situation as well. And then also, there are many times too where we've seen, married couples living in a home, but one of the spouses did the mortgage and is only the one on title and the other one's not on title. If that is the situation and the other spouse has not been on title or on the mortgage for the past 3 years, they could be considered a first-time home buyer as well. And as we know, first-time home buyers have lower down payment requirements and things like that that can help them when qualifying to purchase a new home if they haven't been on the marital home. Anyone have any questions regarding this? And I see need to chat back with a name. Oh, that's Cindy. Okay. Anyone have any questions regarding this?
Question?
Sure.
Yeah, it's just easier than to type it in the chat. So thank you. The comment about married couples can be exempt up to 500K gain. Does that mean if they're considering divorce but amicable enough, they should almost stay married if they're planning to sell the house? And that's easier than if they were legally a separate entity? How does that work?
It could be because it's, yeah, it could be because a single person, I think, is only exempt up to 250,000. So again, that's a conversation to help educate them about. And again, that's why you want to have the CPA, because obviously this is just, what I've been told from a CPA, but I'm not an expert in that in any way, but that's a conversation to have with the CPA and also help recommend them to have one as well, because you're right. It could make more sense for them to sell the home prior to them getting a divorce. So that that exemption for the capital gains is larger than if they, separate, divorced, one had the home and then decided to sell. So that's a conversation to look through all the scenarios. And that's really what I think us, and our roles are, is to help educate them so that they are fully aware of all the different situations and scenarios that are available to them so that they can make an educated decision. Unfortunately, in divorce, there's a lot of emotions and a lot of, can be a lot of adversity. So that's where they need someone that can kind of come in and help be a unbiased opinion, but give them the information they need that hopefully they can come to something that's going to help them, for their future. Anyone else have any other questions? All right, I think there was another question. Why the disparity between receiving child support versus paying it in terms of the 3-year time limit? Regarding it is because for Fannie and Freddie, they want to see that you're going to be receiving that child support for at least 3 years. And that's a pretty consistent guideline they have in a lot of different incomes. Like if you are receiving like restricted stock income, other types of income beyond just child support or alimony, they have a 3-year continuance. They want to see that any income that we're using is going to have a likelihood of continuing for 3 years. Whereas regarding liabilities, most of the liabilities we have to use up until it's paid off. So there's just, because they want to see that the income is going to continue so that they feel like if we're using it to qualify you for a home, that you're going to have it for a good period of time, so that when we're using to say, okay, they're getting this income to help them qualify to be able to afford this home, they feel like you have to have it for 3 years in order for that to be justified. Whereas the debts, the situation, it could be like if it's ending within a 10-month period, we may not have to count it. That's how it is like on a car, for instance. If you have a car loan and the car is going to be paid off within 10 months of us going to closing on the loan, we don't have to count that car payment. So we could try to get an exemption to that rule and not potentially have to count it if it's less than 10 months that they have to pay it. It's kind of a case-by-case basis and how we could handle that. So hopefully that answers your question. If you have anything else, let me know. Okay, if anyone else has, and like, I think it was Amy that just spoke, please feel free to unmute yourself, because I agree with you, typing all of that. I wouldn't want to do it myself. Okay. All right. So when listing the marital home, here's some other things to keep in mind and things to look for in their separation agreement. So if you're meeting with them early in the process and they haven't done the separation agreement and they're just kind of starting to think about it, and they're again wanting to just educate themselves on what this would look like, or if they've already written it, here's some things to keep in mind. So mandatory price adjustments. Now, obviously the market we're in right now, some of this isn't going to really be as worrisome, but I think it's good things to know, because eventually this market's going to shift, right? So we want to be able to know how we can help these clients down the road, not just right now. So, thinking about like figuring out the pricing, and that's where that competitive market analysis comes in. The CMA is something that I would highly recommend, encouraging them to use with you guys as the experts to help determine the value. Because if they do an appraisal, that appraisal that's done as part of this process, obviously we all know appraisals are not cheap. They also are not going to be able to be used in the lending process. So if they're planning to keep the home and one of them, is going to stay in the home and the other one, they're going to have to buy out the other one, and they're doing that appraisal potentially during that process, that appraisal is going to have to be redone when we go to do the mortgage, to take the other one off the mortgage and potentially buy out the other one. So that's why, in order to save the money and not do something that's not going to end up being able to be used, I think the competitive market analysis is a great way to start to give them an idea of what that value looks like. So then they can figure out mandatory price adjustments, mutually agree on what that timing and percentage looks like. If they, want to start really high, then talking to them about what does that look like, and like we said, there's times where this is written in the agreement. So that's where you want to look at the agreement to see if it is. Accepting offers, again, what is going to be an acceptable offer? Right now, again, that's not something that's relevant, but again, down the road, or if it's a house that needs a lot of work and they don't want to do anything to it, that's something that you might be talking about is, okay, what's going to be a reasonable offer and coming to an agreement with both parties. And then also addressing how the sharing the costs of the home, getting it ready for sale, if they're going to do that, or if there's a home inspection done, what those repairs credits might look like and what they're willing to do and how that's going to be split. So those are just conversations they want to, you want to have with them as well. Any questions on that? All right, credit. The other thing that I think unfortunately happens in a divorce situation is that credit can really get destroyed. So again, I think this is a conversation to have, an education, and I think this would be a great video to do to your sphere as well, just talking about, unfortunately, if this is something that you maybe encounter down the road, these are some things to keep in mind. Obviously, we know that credit has a huge impact on the mortgage process. And what I recently talked to a realtor, and I'm sure you guys have seen this as well. I also know when you're going to rent, like I had a realtor tell me last week that most landlords are looking for a credit score of 700 or higher. So it's going to impact them, whatever they're looking to do, whether or not it's looking to rent for a while, or if it's looking at buying a new home. So, recommendations that I would give is that they need to try to separate their liabilities as soon as possible. So obviously car loans and things like that can be challenging, but they can look at having the other spouse refinance the loan and get them off of it. Close credit cards that are in both their names and open their own credit card. The mortgage, we've talked about that as well. So anything that they can do to separate their liabilities is going to really be beneficial to them. And then also recommending to them to make their payments, continue making the payments on time, to try not let their pride and their anger, affect them in their ability to, because credit stays with you, as we all know, for a long time. So when there is a derogatory item, and a late payment, and even multiple late payments, or even one, it can have, a devastating impact on the credit score, which is going to stay with you. As we probably all know, late payments stay on a credit report for 7 years. So this isn't a short-term thing that's going to have a short-term impact. It can have a long-term impact on them. And then not assuming that their spouse is going to be making the payments. So, it's something that I was very conscious of when I went through it myself, being in this world and in this industry. So it's something that we want to just help making sure that we can help educate others on as well. The good news is that when someone comes to us and they're worried about their credit, we can have them fill out a pre-approval application. We can look at the credit, and then we have what's called a what if simulator. So we can look at this and say, what can we do to get this credit score from this score to this score? What would it take to do that? Or what if, they paid off this credit card, or they got rid of this mortgage or this car loan? What impact would that have on the score? So we can do some education for them as well and help prepare them either to say, here's what could be done right now, or here's what you can be working on for the future. And here's a time period of what we think it might take for you to be able to get to a point where that credit is in a position to make it more beneficial for you when you're looking at purchasing. So credit is, something that I just hate when I run a credit report and they told me that they've gone through a divorce and their credit just took such a huge beating. So again, I think it's just something that we can try to do as much as possible to educate and encourage everyone to, stay. And I know, there's situations where they just don't have the income and the ability to do it, but anything they can do to help themselves is going to stay, help them for the long term. So Marissa, is your credit simulator something that will let you, will tell you what your CR score will increase to if you pay off a car loan? Yes. Yeah, so we have the ability to say, okay, if we have this car loan and it's now at a zero balance, what's that going to do to the credit score? So we have that same thing like with the mortgage or credit cards. A lot of times what I see is credit cards, and especially during the divorce, and I had it myself, your credit card balances go high, trying to absorb some of the expenses. So obviously we know that, credit limit versus credit balance has a big impact on the score too. So if we show they're able to pay the credit card down to a certain level, we can then see also what impact that would have on the score and how much that would increase. Anyone else have any other questions on credit? All right. Funds for a down payment. So this is, obviously applicable to someone going through a divorce, but anyone, so any client that you have, obviously. And this is something that I just educate borrowers on, because a lot of times they don't realize it. They think about and focus only on what they have available themselves and what they've been able to save, and I try to just open their eyes to say, okay, here's some other opportunities that you might have to gain funds for closing, so that they can think about it, look into it, and see what that might look like for them. So obviously their own savings and investments that they have. Gifts from family and friends. Almost every loan allows a gift now. The only loan I can think of really off the top of my head that doesn't is if it's an investment property. The investment property, the funds do have to come from you, but otherwise, almost every other loan we have allows a gift from a family member. And gifts right now, it's super easy to document. There's a gift letter that they fill out, and then we have, a conventional loan. We're going to have the donor wire the funds directly to the title company. And then we have to have the donor fill out that gift letter. And then we have the donor wire the funds to the title company for closing. We get a copy of the wire transfer from the title company showing the money coming from that donor to them for that amount. Excuse me. And that's all we have to do on a conventional loan. So that it's can be very simple and also allowed. Sorry. The other thing is retirement accounts. If you are with an employer, you normally can borrow from a retirement account, from your current employer, and pay yourself back. It's tax and penalty free when you're doing it to purchase a home. It's usually at a low interest rate, gives you usually a decent period of time to be able to pay the loan back. So it's not at a very, high payment. But that's another way to be able to obtain some funds to be able to purchase. And again, that goes to when one of the spouses, may not be a primary wage earner. If they are 62 and a half or older, we can also use investment accounts as income. So that means that, like, let's say they have a 401k that's worth $1 million and they're over 62 and a half and they want to look at buying a home on their own. We can take that $1 million asset, divide it by 240 months, and that gives us a monthly amount that we can use for income to help them for qualifying. And again, that's on any Freddie Mac loan that we do, not just related to divorce. So I've been doing that a lot lately because we have a lot of clients that are purchasing homes over that age. They have good assets, in their retirement account. That way we don't have to set up a distribution for the retirement account. We don't have to have, it's called asset depletion, but it means we're not depleting any of the money. We're not taking anything from it. We're just giving them credit for the amount that they have in their retirement account. So those are some other ways of getting income too, depending on the age of the client. Anyone have any questions regarding the funds for down payment? All right, like Cindy said, I love interactions. So anything you guys give, let me know. That's it. So thank you all. If you guys have any questions now over anything I just talked about or anything that I haven't touched on, I'll go back and look at the questions you guys had earlier. We'll go over those real quick. So Another question is, are there general guidelines for repayment of loans versus retirement plans, or is this specified to the employer holding the plan? It's specified to the 401k holder. So whoever is managing that 401k is that's where the interest rate, the repayment plan, all of that is going to be determined by them. So you want to be reaching out they'll want to reach out to their 401k provider and see what those guidelines look like. You know, like I've explained to my clients in the past, you're paying yourself back. So, you know, everyone, you know, is going to say, ideally, it's not, you don't want to take from your retirement account. The good news is when you do that, is you are paying yourself back. If it's early in your years and you have the ability to, you know, rebuild that and not hurt your, you know, short-term future for building, you know, continue to have that compound interest. Those are conversations you want to think about. But there's definitely, you know, it's definitely a resource that you can look for to see if that's going to help you be able to achieve their goals. All right. So how do you advise clients who are going through divorce, who have been recently divorced? Okay. So I think we touched on that. And Claire, if I didn't, if there's anything else you'd like to know on how to advise the clients, let me know and we can talk about that. Amy, top 5 considerations that should be addressed with a person in considering divorce. I think we've talked on that as well. You know, so if we go back to, you know, to this, it's talking about you know, is there child support? Is there alimony? What is their marital home? What are the plans for the marital home? You know, talking about credit, you know, all of those types of things are things that you want to help educate them on. And also, you know, like we talked about, kind of feeling out if there's anything that you could do to help them with their financial planning and recommending a financial advisor. If there's, you know, counselor, things like that. Those are all the things you want to keep in mind. All right, want to know the unusual different practices are financing for a divorcee. I think we talked about that too. It's, you know, buying out that client, you know, rate and term versus the cash out is one of the big differences. Also being able to not count debt, which I think can be very beneficial. And then documents, we've talked about that too. So, you know, the separation agreement, divorce decree, written agreement that if they don't have those, that's been signed and notarized by all parties. And then a woman, you know, who may not have been the primary wage earner, ways of how they'll be able to. So, and then this other one is, I happen to have a listing appointment. The husband gave the house to the wife through the separation agreement. I told her that he may still have to sign the listing agreement. Is that correct? Yes. If he's still on the deed, since like you said, there's no quitclaim deed that's been done, he's still an owner of the home. So he would have to be on the contract, the listing agreement. And as well as, like, you know, what they're going to be looking for, like a buyer, the lender of the buyer of that property is going to look to see who is the owners of record. And they would have to have him added if you didn't have him, because he's still going to be listed as owner of record in the county. All right. So Amy, very important thing. Oh, awesome. Okay. And then Melissa, a few months ago, I was about to list the marital home for clients of mine. The day after the listing away, they had a domestic dispute and he no longer stayed in the home. Are there any resources you can share for me to help guide the wife? Again, that second Saturday workshop, I think would be huge. You know, there's, like I said, there's an attorney that is present in that workshop, and they can ask that attorney questions, you know, without, like I said, I think there's like a $25 fee for the workshop. So it's a great way to be able to ask questions without incurring, you know, a big either retainer or hourly fee to go talk to a divorce attorney. So that would be a great resource, I think, for them. Or obviously it would, you know, be able to go and pay that hourly rate and meet with an attorney and see what her options are. And then follow up, what if the wife wants to stay in the home but can't afford to buy out her spouse? That's, again, unfortunately, an agreement that they'd have to come to, because I've definitely seen in separation agreements where the spouse gives the other one a period of time to be able to do that. You know, they could give them a year, 2 years, 3 years. It's all about, unfortunately, what the other spouse is willing to do. But I would also say, you know, talk to a lender and have the wife talk to a lender, because sometimes, you know, people think they can't do something when in actuality, there's ways they could potentially do it. So you could also have a co-signer, you know, so like if the wife wasn't able to afford it on her own, you know, qualify, but was able to make the payments for, you know, like she may not have been getting child support for 6 months or alimony or whatever it may be. if she has someone that would, like a family member that's willing to co-sign the loan for her and allow her to do that, to keep the home that way, that's another option. I did have just a recent situation. We do have one investor where I had a divorced woman who was going to be buying a pretty substantial size sales price, was going to be putting a lot down. She got a decent amount of money from her divorce. So she's putting like 30% down. She had only been receiving child support for 2 months. This particular investor we had, because it's not Fannie and Freddie, was going to allow me to use that income, even though we didn't have the 6-month history. So that's why it's really important for them to talk to a lender if they feel like this is anything that they're considering doing, because there could be situations where we have unique opportunities, investors that we could make things work. But like in that situation, I was able to do it because they were putting a lot of money down and they had funds like reserves after going to closing as well. So again, I would just have her recommend her talking to somebody so she just knows what all of her options are. All right, anyone else have any questions? Well, thank you all. I hope you found this useful and helpful to you. If you ever have any questions, or if you have a situation down the road that you can't remember what we talked about or what that guideline was or what that situation was, please feel free to reach out. I'm happy to help and be a resource for you all, and have a great rest of the Friday.